Good morning or good afternoon, everyone, whenever or wherever you're watching this video. It's Ankit. Thank you for taking the time out of your busy schedule, for hitting the subscribe button, and watching today's video. I hope everyone's having the best day of their life or the best week of their life. If you found value in today's video, make sure to subscribe for more videos like this. Most of my videos are usually about investing, health, and life. Today's video is going to be about 9 important investing advice from Warren Buffett that can make you a complete investor. If you use all 9 of these, you might be able to get returns like Warren Buffett does. Leave a comment below with what advice you would give to a new investor, current investor, or just any investor, and why you would give this advice to them. Let's try to hit 7,000 subscribers in 7 months. With all that out of the way, let's get into today's video about these 9 important investing advice. You have to make cars that people want. Warren Buffett on Elon Musk and Tesla. So here's what Warren Buffett had to say about this. Buffett added that all other automotive companies, but Elon Musk is finding ways to beat legacy automakers, taking on General Motors, Ford, Toyota Motors, that have all this stuff. He's got an idea and he's winning. Buffett also said that there's a lot of companies that produce cars, but ultimately you have to be the one who makes the cars that people want. Buffett also acknowledged during the interview that we should be doing more to fight the climate change, but didn't elaborate on the impact of electric vehicles. First on our list is investing is a long-term game. Only buy something that you'd be perfectly happy holding if the market shut down for 10 years. How long are you willing to stay with this investment if it does not perform the way you expected? These are hard questions and they go deep into your suitability as an investor. Not everyone is well disposed to be an investor. Not everyone should invest on their own. Most people are looking for validation. They need a sign quickly that their investments are good. The only way to play the long-term game is to be utterly confident in what you're investing in. Next thing you should do is know your investments well. What an investor needs is the ability to correctly evaluate selected businesses or companies. You need to remove all the risk in your mind before you invest in any stock. There are 2 ways you can go about doing this. 1, use external tools to remove risks without spending time to understand what risks are and is. For example, you can blindly diversify your portfolio to hedge against the risk you don't even know that exists. The downside of this is that you also hedge away your returns. And the second thing you should do is know everything there is to know about the business or company so you completely understand the fundamentals and the business specific risk. If you know what makes the business tick, what drives the industry, where the strengths are, what is the management strategy, what is the demand like, and everything else, you can indeed not worry about your investments if the market shuts down for 10 years. And why? Because now you're thinking about more like a business owner and less like a speculator or a passive indexer. And number 3, you have diversification is not always a good idea. So if you haven't watched my video about all the mistakes that you can make as a new investor and a current investor, I highly recommend you watch it because it'll go over a lot of the mistakes you can make as an investor. Diversification is a protection against ignorance. It makes little sense if you know what you're doing. Risk comes from not knowing what you're doing. You want to diversify because you want to cut down on the risk. You may have risk because either you don't understand the investment or business or company, or you don't have the appropriate long-term orientation. You diversifying by buying more stocks that you understand even less. Sure, you will eliminate some of the risks by the random chances of something canceling out something else, but you can also increase your correlation to the market at the same time, reducing your potential returns. All because you do not wish to spend time learning about the business you're investing in, or finding someone who does. Yes, you can own multiple stocks. Each stock should have its own thesis and financials and everything else. But if you have only one idea, and does this make your portfolio very risky because it is not diversified? I don't think so. Unless you decide to put 100% of your capital into one stock or one place that you know not much about, nothing compels you to do this. You do have a choice to invest according to your convictions. So advice number 4 is to be patient. Stock market is designed to transfer money from active to the patient. What do you do when you get cross conviction with long-term orientation? You get patience. And patience is the absolute requirement to succeed in your investment career. This also means that day trading or frequent transactions are not advised. Transactions costs, of course, are a bigger factor, but also worth nothing is that when you do this by necessity, you are putting less trust in the business you are investing in. And you are putting more trust in the other investors to be greater fools than you. They will create opportunities for you to make quick profit. When you invest with patience, you trust the business to create value over time. You trust that there will be demand over time. And also you trust that the value of the stock will reflect the improving business value. You are trusting the economy system to continue to be working the way it's been since man started trading. It takes 20% to grow from 100 to 120. However, if you lose 20% of your $100 capital in 1 year, you will need another 3 years of annual 20% growth to grow past $120. This is setting you back 3 years. You can choose to not invest in a shaky idea. Look for another that you feel more confident about. This is the mathematical reason anyway. Psychology, if you follow this rule, you will be, and the next thing Warren Buffett advises is never lose money. You probably heard this a million times, so I'm going to quote it again. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Great investments compound your portfolio. You do not wish to reverse the compounding effect. It is easier to not invest in ideas you do not feel confident about than invest and lose money and set your portfolio back a few years. Or put in more tangible terms, it takes 20 years diligent in considering all sorts of risk before you make an investment. You will be more diligent in assisting margin of safety to cushion you in case something don't turn out the way you expected, as things inevitably will. Number 6, he advises you to price does not equal value. Price is what you pay, value is what you get. This is the core tenet of value. This is the repudiation of the efficient market hypothesis. It is possible to buy $1 with 50 cents, but it takes time and effort and skill to PEG a value of $1 to an investment that is selling for 50 cents. Most investors are not able to do this, so they look for stocks that sell for $1 today and are likely to be worth $2 tomorrow based on some complex projection and analyst sound bites. Speaking of sound bites, we are all taught as a kid, a bird in a hand is worth more than 2 in the bush. An undervalued stock is a bird in a hand, but still investors would rather chase the 2 in the bush. Number 7, investing is simple but not easy. The business schools reward difficult, complex behavior more than simple behavior. But simple behavior is more effective. The way I judge my investment thesis is how simply can I explain it to a 5-year-old. If I can't do it well, then maybe I don't understand the business well enough. Or the business is just too complex for me to understand. If I have to build an Excel model to forecast 10 years of earnings at a certain growth rate and a terminal value and figure out the value of cash flow, all well grounded in theory, by the way, it just means that I do not understand the business enough to invest in it. This is also the reason why I gravitate towards smaller company stocks. A company with a one or two products or services is much easier to understand than and to understand the profits from it. The simplicity requirements provides all aspects of investing. For example, my businesses do not need to have a strategy for everything. They just need to do what they do well. And if they can't return the money to the shareholders, then that's a problem. You can always question yourself 1,000 ways. For example, I get asked this question frequently. If the stock has such a great value, why is it selling for less? The simplest answer is most investors do not know the value. This answer is most likely to be true, but many complex hypotheses, and eventually they talk to themselves out the lucrative investment. Next, load up the truck when you find a great opportunity. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. What does loading the truck mean? It is not a call for you to be indiscreet. It just means invest according to your convictions. You buy more of the stock that you feel greater conviction for. You buy less or none of the stocks that you do not have enough conviction for. I cannot give you a formula for this, although there is a mathematical formula to maximize your wealth. I will just say that you have to figure this out with your experience and time. Last on the list is doing nothing is often wise. You do things when opportunities come along. I've had periods in my life when I had a bundle of ideas come along, and I've had long dry spells. If I get an idea next week, I'll do something. If not, I won't do a damn thing. A simple idea, but so hard to execute. Some investors are compelled to buy something and anything because they do not have the long-term orientation. They need to see profits now. And if it doesn't work out, there was something wrong with the stock. Doing nothing when it's the wisest thing to do is taking responsibility for your investments. Doing something in a haste because you just, get into something is being irresponsible and irrational. Some people believe that there is always something that you can do or invest in. Sometimes there is not, unless you validate other tenets of good investing, such as staying within the circle of competence, or being patient, or need to understand the business well, and all the other factors that can come along. Some investors are compelled to buy something and anything because they do not have the long-term orientation. So these are the 9 nuggets for Warren Buffett investing style principles that I find really incredibly important to learn and to live by as an investor. It's something you should consider when you're investing in your next stock or a company that you want to buy, or any other investment that you're considering.